So it's the end of the tax year. Yes, on the 31st of March or the 5th of April will be the end of the tax year. So it's time to be looking at your accounts now and seeing where you can save tax and make sure that you've got everything in order. Welcome back to Property Insight. My name is Mark Ashworth.
I'm Neil Harding.
So end of the tax year happens every year. It's actually not the 31st of March, is it? But that's where I run my figures to, but it's usually the 4th of April, right?
Yeah, it is. And HMRC for quite a long time now have pretty much accepted that if you're running a limited company with a year end of the 31st of March, to be honest, for all intents and purposes, they don't really care about the 5-day difference between 31st of March and 5th of April. You can run it as the same from a practical perspective. So as investors, as property investors, things to think about to get done. Not a lot of time left, but there's still time to maximise or let's say optimise your tax position. One of those things is ISAs.
Mm-hmm. So we've got a £20,000 allowance each person each year. Does have to come out of your tax paid income though, doesn't it?
Yeah.
So it has to come out of your personal income. It can't be taken from your company, unlike a pension can. But yeah, so you need to be looking to perhaps maximise that ISA, because once it goes past the date, you can't get it back again. So it's £20,000 each year. Most savvy investors are probably fully aware of that.
Yeah, use it or lose it.
Yeah, so if you've got money sitting around that you don't want to invest in property, or you want to diversify, which is probably more important, I think people that are into property definitely want to put as much as they can into property, but it's well worth the tax-free, because it's completely tax-free as well. So if you're investing in something a little bit more risky and better return, like stocks and shares ISAs, then you're probably going to get better results in the long term in there than you are just in a cash ISA, which is probably arguably about the same rate as a sort of a savings account that might be, what do you call it, where they lock you in for 6 to 12 months.
Fixed rate returns. Yeah. And the other thing, you are interested in property investing, and even with your ISAs you want to invest in property if you can. There are still sort of indirect ways of doing it. So if you're investing in a stocks and shares ISA, you might be able to find a product that actually focuses and centres on companies that invest in property, but also innovative finance ISAs. And I don't know if you've heard of innovative finance ISAs. They're less well known, and you tend not to hear an awful lot of people talk about them on things like Which Money. They don't really get much of a mention. But innovative finance ISAs, and I've invested in them, and I think you have, Mark, as well. Yeah. And it's a way of almost being able to fractionally invest in property project. So you can put your £20,000 along with lots of other people putting in £10,000 or £20,000 to a property project, where a property developer might be looking to raise millions. And sometimes they will come with a first charge or a second charge, so there is security quite often with those as well, and you can get a higher rate of return than maybe with a cash ISA.
Yeah, they're well worth looking at. I did it for the first time last year. But it's interesting what you say about financial podcasts and financial education, certainly online. It does often talk about ISAs just being stocks and shares or cash.
Yeah.
It doesn't really talk about any other types, and I guess it's probably because it's fairly big risk. And often, they don't really like talking about things that are too risky, because they don't want to be seen to be giving financial advice and that kind of thing. But and we're not either. It's just a case of us really just sort of like telling you that stuff out there exists. People are borrowing money to do all sorts of deals, and in property, really, people don't have large sums of cash sitting around in the bank. So to pool everybody's resources together, and if you've got somebody there or a company there that is got some good history and they're well trusted, then obviously it does still come with a risk, but it's generally well worth investigating those to see what's available.
Another great tactic as you approach the 31st of March or 5th of April is, to the extent you possibly can, calculate what your taxable income is going to look like now for the full tax year. So that's both the taxable income that you might be declaring on your self-assessment tax return for personal income tax purposes, but also the taxable profits that you might have if you own a limited company, for example. A lot of your transactions you'll probably know between mid-March and the rest of the month, and another 2 weeks to go. So it's well worth doing that calculation. See if the level of net income or profit that you're going to arrive at is in the sort of horrid, dreaded zone of just the highest rates of tax that are in existence. So what I mean by that is, if you're in a limited company, you pay 19% corporation tax on profits up to £50,000. Between £50,000 and £250,000, you're going to be paying 26.5%, and above £250,000, it drops to 25%. So obviously, the highest rate there is 26.5%. For example, if your profits are going to be £60,000 in a limited company, you might prefer to make a £10,000 pension contribution from your company to drop your profits down to 50,000, just to avoid paying 26.5% on that 10k, and then you'll just pay 19% on the 50k. As a simple example. But using pensions is quite we've talked about that before on other videos. It's quite a useful tactic, and you can do a similar idea with any pensionable net income you have that you would be declaring on your self-assessment tax return. So, you know, the dreaded sort of earning £60,000, let's say, you know, child benefit disappears. Above 50, it disappears. Above 60, it disappears completely. So they're things to think about.
I think one of the big issues that you have when people are running their own businesses, or whether they've got the side business of a property, so let's say they could still be earning in a normal job, but they might have a side hustle as a property investment, which could be in a limited company. I think one of the things that often people make the mistake of, particularly when it comes to tax, is they come to wait until the end of year is done, then they have a conversation with their tax accountant to then determine what tax is payable. But obviously once that time's passed, it's too late. You can't then go, oh, well, I need to put some of that in the pension, or I need to perhaps buy a new computer, so why didn't I do that in that previous tax year? Because it's too late. You can only do that transaction before the end of the year. So there is an argument to say that actually the meeting with your accountant should take place before the end of the financial year to try and determine how it is. But I think that also brings forward the suggestion that you and your company, your partner, whoever it is that's running that business, should be sitting down, particularly if you're expecting profits, should be sitting down now, and you should really, at the touch of a button, be able to find out what your profit is within, let's say, 10%, so that you know what you should be doing with that money. Because otherwise, what will happen is that you'll end up paying the corporation tax on the whole lot without any sort of real opportunity to reduce the tax bill in some way, shape or form. I mean, if you're intending to make the profit and to reinvest it in property, there's not an awful lot you can do if that's what you want to do. But obviously, if you want to do things like reduce that tax bill down by investing it in pensions and things like that, you need to know what money you're going to put in there.
Yeah, it's a really good point. There's no magic time machine with a lot of this stuff. So if you get past the 5th of April and you haven't paid any money into your pension, you can't pretend that you did it 3 weeks ago. So if you missed the boat and the time moves on, it's too late. So yeah, I think meeting with your accountant both before and after your year end is a really good idea. There's one more thing just to mention quickly, which is national insurance contributions. So for anybody who is looking to make sure that their NI stamps, to use the old phrasing, are full, to make sure they get the full state pension benefit. I think you need 35 years worth of NI book stamps, and so that's 35 years of full contributions in order to get the full state pension. So at the moment, the government is allowing people to fill with voluntary contributions if they need to, all the way back to 2006. But that window closes very, very soon. I think it's actually the 6th of April coming up. So go onto the government website, look at if you log into your self-assessment portal with the government website, you can look at your NI contributions and you can see what years are full and what ones aren't. And it might be worth filling with a voluntary contribution. I think a full year's contribution is somewhere around £700 from memory, something like that. And then it's well worth doing that. After this year, you can only go back 6 years. Well, that's everything. Hope you found that insightful. And please do comment, like, and subscribe to the YouTube channel. It really helps us promote the channel and continue to deliver more content in the future. Look forward to seeing you next time.